Hi Ross, thank you so much for the introduction. Just to let you know that we've got really high numbers on the call today, and I'm really delighted to have so many people here. So look, a very big welcome to everybody. I think it's testament to the speakers that we have today to help us manage through some of the issues in managing your supply chain in the area of VAT and customs. And just to keep you an update really of who we have speaking for you today, and a little bit of overview about the agenda, and I won't keep you too long because I know your time is precious. The session will last for an hour, and we were going to do some Q&As at the end. Just in terms of the volumes of questions we've received in advance and also what we expect to get in, I just wanted to let you know that it's unlikely we're going to get through all your questions today. And it's very, very apparent that there is a lot of uncertainty in this area. So with that said, we will repeat these sessions and we will repeat this information. So you'll get this more than once. So if you miss something today, just don't be afraid, because we'll come back and we'll do this all again. We'll repeat the slides, and the speakers have agreed to, they're on board with that as well. And just sort of to give you a bit of an introduction to the speakers, we have Frankie Devlin, who is a partner in KPMG Belfast, and Frankie covers all areas of indirect tax, VAT and customs. We have Colleen Flanagan, who is a manager in PKFPM Accountants Limited, and Colleen is a manager within PKFPM, an associate of the Chartered Accountants in Ireland and a qualified chartered tax advisor. So you're in really capable hands here for your VAT. And then we have another two very, very experienced experts in the area of customs who will jointly present. We've got Elinor Paterson, who is the NI Stakeholder Engagement Lead for HMRC, and she joined HMRC in 2004 and has joined a number of roles in that area in customs, international tax and compliance, so lots of experience. And then finally we have Ray Ryan, who is Assistant Principal in the Customs Division in the Revenue Commissioners. And Ray has over 10 years experience in the Revenue Customs Division and responsibility for the Brexit Trader Engagement Programme. So as you can see, that is a really good lineup today. We'll also be joined as well by the wonderful Denise Marin, who is a project manager in the InterTradeIreland Brexit Advisory Service, and we'll also get an update on supports. And I'll move quickly along, but just to let you know that you know, the session today, it will be focusing on your trade routes, okay? And so think about your supply chains and where your goods are moving from and where they're moving to. And it's just focus on that one thing. And each of your speakers today will focus on a trade route, okay? So I without further ado, then we'll pass you over to Frankie. Frankie will cover VAT and also then GB to NI and also transit as well. So I'll pass you over to Frankie. Thank you.
Okay, thanks Deirdre, and I hope that is, my slides are showing. I'm going to just
That's perfect.
Yeah, okay, very good. Well, that's the first test passed anyway. Good afternoon everyone, and welcome to the webinar. So as Deirdre said, I'm going to talk about some VAT issues, and Colleen is going to talk about some further VAT issues. So what I'm going to focus on is in relation to the GB, NI, NIGB issues in particular, and Colleen will deal with EU transactions and goods, but also services as well. So I'm going to focus on trade and goods between GB, NI and NIGB, because that's where I suppose a lot of the significant changes have happened. So before I get into the detail of that, I just wanted to give a very quick general overview of some of the key protocol issues with regards to VAT. I think it's fair to say that a lot of the focus has been in relation to the customs changes, which are very new for businesses. VAT is not so new for business, but with the protocol, businesses in Northern Ireland in particular are having to get used to new systems, new rules in relation to certain transactions and goods. As we know, Northern Ireland does remain part of the UK VAT area, and HMRC will continue to operate that VAT system and the collection of VAT and obviously the policing of submission of VAT returns, etc. And thankfully the UK VAT number and the UK VAT return will continue to be as they were before, so that's all familiar to you. However, because of the Northern Ireland Protocol and because of our unique position whenever goods are moving into Northern Ireland, particularly from Great Britain, which effectively means that they're moving into the single market, we have to apply EU VAT rules to that whenever we're relating to goods. So for that reason, the VAT legislation has had to be updated. So there are a number of new, very important statutory instruments and schedules within the VAT Act. They're listed on that slide there. Importantly, HMRC have also updated the relevant VAT notices and the guidance to cover those changes in relation to goods. So again, I would point you in the direction of the VAT notices on the HMRC website. And I suppose ultimately, because we are going to be applying EU VAT rules for goods in Northern Ireland, the EU Principal VAT Directive, again, is going to continue to be very relevant to us, as is case law from the European Court of Justice, which applies to cases relating to goods. In relation to services, the Northern Ireland Protocol does not apply, so therefore Northern Ireland will continue to apply UK VAT rules for services. So again, if there is changes in the future that the UK applies for services, Northern Ireland would follow those, whereas if the EU introduces changes or there's new case law, Northern Ireland will have to consider that. And again, HMRC will, I suppose, have to implement whatever those changes are. So I suppose Northern Ireland's in this position where we're part of both the UK system in relation to services and administration, and all of that will look quite familiar, but also we're integrated into the EU VAT system, and EC sales lists and Intrastats and all of those things will have to be reported whenever goods are moving from Northern Ireland to EU member states. In terms of recovery of VAT in other member states, because again Northern Ireland is part of, I suppose, the single market for VAT purposes, we will have access to the 8th directive or electronic VAT refund system when we're claiming VAT on goods incurred in another member state. However, if we incur VAT on services, we'll have to look to the 13th directive system. So again, there's certain things that we'll have to get used to and know which system we're applying. Again, just in terms of the Northern Ireland Protocol, important because obviously some businesses will have operations in Northern Ireland as well as the Republic of Ireland, but also in Great Britain as well. So you do need to consider whether the Northern Ireland Protocol applies to your business and to which parts of your business, because it may apply to certain supplies of goods, but maybe not to others. If, for example, the goods are being dispatched or supplied from Great Britain to an EU country, then the Northern Ireland Protocol in that case may not be applicable. So getting into some of the detail, whenever goods move from GB to NI and the other way around. So again, a lot of the talk has been with regards to customs and the sea border and the issues that's arising there. But again, we do have a VAT issue arising there as well. So effectively, that's why the EU VAT rules apply when goods move from Great Britain into Northern Ireland. And again, if you look at the UK guidance, there's quite a lot of it that outlines this in fairly good and clear English policy papers and guidance. But effectively what that's saying is that technically and legally, whenever goods are moving from Northern Ireland to GB or GB to Northern Ireland, that's effectively an export and an import for VAT purposes, as it is for customs purposes. However, HMRC in implementing that change, and I suppose in order to keep things as much as they were before and as simple as possible for businesses, they have said that although that whenever goods move from GB into Northern Ireland, and that's effectively an import VAT would arise, that import VAT will be accounted for by, say, the GB supplier. So they'll account for it in the same way as output tax on their VAT return. If they're supplying to a Northern Ireland-based customer, and I suppose the input tax recovery by that Northern Ireland customer will depend on the normal rules if they're using it for the purposes of a taxable business. Important, I suppose, as well, just to note that whenever goods are moving across that sea border, GB to NI, because we do have a customs border there, the value of the imported goods for VAT purposes is technically the customs value. So I suppose technically, if there was a tariff implication, that may have to be taken into account whenever you're determining the value of the goods for VAT purposes, because our Section 21 of the VAT Act sets that condition down. I think in most cases, if goods are moving GB to NI, and that's the end of the matter, there shouldn't be a tariff, and therefore it's probably not a significant issue. But again, just to be mindful of that customs value issue and what documentation you might need for VAT purposes. As we've said, the boxes on the VAT return will be the same, the 9 boxes that we're used to. There are a couple of exceptions outlined in the HMRC guidance as well. Whenever the way that the VAT is accounted for when goods move from, say, GB to NI will be different. And that's really whenever, for example, goods are moving, say, under a customs procedure, so customs warehousing or inward processing relief. In that case, the supplier wouldn't account for the output tax or account for the import VAT as if it's output tax. In that case, because the VAT is suspended whenever the goods are moving from GB to NI, it's not until those goods are released from that customs procedure in Northern Ireland that the import VAT would arise. And again, it's going to be the person who's removing the goods from that procedure in Northern Ireland that would be liable for the import VAT. And there's a few other examples there where that will apply, where there's an exception to that sort of simplification rule that would apply. I suppose the final point in that slide that I would mention is that always be aware of the customs implications, not just thinking about the VAT implications whenever goods are moving from particularly GB to NI, because I think it's fair to say that when goods move from Northern Ireland directly into GB, in most cases that's fairly straightforward in terms of VAT, and it's, I suppose, effectively like a domestic supply apart from a number of exceptions. But when we're moving goods GB to NI, because of the customs implications and the at-risk goods implications, which Ellie and Ray will get into a little bit later, do always be mindful of the interaction of VAT and customs. So just picking up some things to watch out for those goods moving from GB to NI. And again, for moving own goods, I suppose previously, if you were just moving your own goods from GB to NI, that wouldn't have been an event for VAT purposes. You could have just disregarded that. However, because of this, I suppose, sea border single market implication when goods are moving from GB to NI, there is a requirement, even if you're just moving your own goods, to account for that as if it is a supply. So it's a deemed supply, and an output tax liability would arise. But again, if you're moving your own goods, you should be able to take an input tax credit at the same time in your VAT return, subject to the normal VAT recovery rules. So that's one to watch out for. Important to note that when the goods move the other way from NI to GB, if you're moving your own goods, there isn't a requirement to account for a deemed supply in that case. So again, you can just move that as normal, and it can be disregarded unless you're actually making a supply. Another one to watch out for is movements of goods from GB to NI within a VAT group situation. Again, we're aware that normally when you move goods in a VAT group, you disregard it and there's not a supply and there's no output tax liability arising. However, again, because these goods are moving into the single market, it changes things, and therefore there is a requirement to, in most cases, account for output tax within that VAT group. Again, taking a deduction subject to the normal rules. If the goods are already in Northern Ireland and the supply is between two members of the VAT group who are established in Northern Ireland, in that case you can disregard that in the normal way, and you don't have to do any VAT accounting reporting for that. The final point on this slide is just worth mentioning the margin scheme, which has been getting quite a bit of media coverage. Initially, we were under the understanding from the HMRC guidance that the margin scheme wouldn't be able to apply for any second-hand goods if the goods were sourced in GB and then brought into Northern Ireland for onward sale. However, further to some lobbying for second-hand motor vehicles, that has now been changed, and the HMRC guidance has been updated. So effectively for now, the position is that the UK have requested a derogation from the EU in relation to applying EU VAT rules. So effectively, they want to keep the rule as it was before, which requires the EU ultimately to agree to that, because it would require a derogation. But for now, the HMRC and UK government are confident that that will be acceptable, and therefore it means that thankfully Northern Ireland car dealers will be able to bring cars, source cars in GB, bring them into Northern Ireland and sell them under the margin scheme, rather than having to account for VAT on the full value of the car, which would make that that market very difficult indeed. So just looking at some complications and less straightforward movement. So this is one, again, it's covered in the HMRC policy paper, policy guidance. So this is where you've got a GB supplier supplying goods to a Republic of Ireland business customer, but the goods are actually going to move from GB through Northern Ireland into the Republic of Ireland. So this is a fairly common movement of goods. The invoice will go directly from GB supplier to Republic of Ireland business. So the position here, or the basic position, or the basic rule as set out in the HMRC guidance, is that the GB supplier will be required to charge UK VAT effectively, because again, similar to moving your goods across from GB to Northern Ireland, there is an import VAT charge arising on import, but that import VAT is accounted for by the GB supplier as if it's output tax. So similarly here, once those goods move across, there is effectively a requirement to account for that import VAT as if it's output tax, and that gives rise to an output tax charge on that invoice from GB supplier to Republic of Ireland business. So that's the basic position, which again, in some cases, may be problematic, because unless the Republic of Ireland business is registered for UK VAT already, it means that they would have to recover that that VAT by way of electronic VAT refund, its directive claim, which again, I suppose there is a cash flow implication there. It would take longer to recover that VAT. So again, you know, there was a bit of a lobby on this point with HMRC in terms of that, and you know, were there any workarounds on that? Now, one of the workarounds, as set out in the notice from HMRC, is that you could potentially use onward supply relief, which effectively means that whenever the goods move from GB to NI, on the customs import declaration, you declare that you want to opt for onward supply relief, which effectively relieves the import VAT charge arising on the movement from GB to NI. And what that means is that effectively acquisition VAT in Ireland will arise whenever the goods move on into Ireland. So that could be one option, which might give you a better result than having a UK VAT charge to an Irish business that's not registered for UK VAT. But again, you need to think about the procedure there and any of the other customs implications. Another potential alternative is to move the goods under customs transit procedures, and I know Ellie and Ray will talk to that a little bit later. But again, that would I suppose mean that there wouldn't be a UK VAT charge arising under customs transit procedures. Instead, the VAT would arise whenever the goods are removed from the transit in Ireland. So effectively, import VAT in Ireland would arise. And again, that may be in some cases a preferred position, but again, you just need to think about the whole transaction together. Then we had an update to that particular guidance on the 12th of January. And again, I think thankfully HMRC did listen to some lobbying in terms of potential alternatives as well. So again, where this lands is, it really depends on where the goods are at the point of transfer of ownership. So again, if that is in the UK, if it's in GB, in that particular scenario, then the VAT position will be as set out above, which is basically UK VAT will arise unless you're using onward supply relief or a transit procedure. However, there is another option potentially. So if you don't transfer the right or the ownership of the goods to the Irish business customer in this case until the goods have actually moved into Northern Ireland. So for example, it could be moved into maybe a warehouse facility in Northern Ireland initially. In that case, effectively, you have two transactions for VAT purposes that you would report. You would treat it as a movement of own goods from GB to NI, as we discussed previously. And then you would have an onward intra-EU supply from Northern Ireland to the Republic of Ireland. And again, Colleen will talk a little bit later about the implications around XI VAT prefixes for intra-EU movements. So again, that's just some things to watch out for on that one. And then this is really just in reverse. Whenever we've got a Republic of Ireland supplier to a UK business customer, but the goods are moving from Ireland through Northern Ireland into GB. And again, this gives rise to effectively a UK VAT charge arising. And just to talk that through, effectively it's UK import VAT arising when the goods move into the UK, into GB. But that import VAT must be accounted for as if it's output tax, which is effectively why the Irish supplier has to account for output tax. So what that means is if they're not registered for UK VAT already, this movement would require them to do that under the basic rule. Possible alternatives to that would be that you could use a customs transit procedure, as we spoke about earlier, which effectively suspends the VAT charge until such time as the goods are removed from transit in GB. So again, that would give rise to import VAT, but it might be that the GB customer will be the person removing it from transit and be responsible for the import VAT in the UK in that case. Again, I'm not going to talk about the customs implications here, but again, whenever goods are moving from Northern Ireland into GB, or potentially even moving from the Republic of Ireland through Northern Ireland into GB, question is, are those goods qualifying Northern Ireland goods or not? Because if they are, then they should get unfettered access and no customs implications for tariff purposes. However, if they're not qualifying Northern Ireland goods, then there may be further implications to consider. And then this final movement that I'm going to just mention is in relation to an indirect movement, where we've got a Northern Ireland supply of goods to GB, but the goods are moving indirectly because they're moving down to the Republic of Ireland, say Dublin Port initially, and then moving on into GB, which again is a fairly common movement for a lot of supplies. So this slide is quite busy. Again, there is a lot of references to customs points here, which I'm not going to cover, but there's effectively two ways that are two methods for VAT purposes that could happen here. And the first one is that you just move the goods under sort of a normal movement. You don't do it under any customs procedures. And effectively that means that you would actually have to have a movement of own goods from Northern Ireland to the Republic of Ireland, which might give rise to an EU VAT implication or reporting obligation. And then you've got an export of goods from, say, Dublin Port into GB, which again might give rise to an Irish VAT registration requirement. Then you've got an import of the goods into GB, and obviously you've got customs declarations on the export side and GB imports on the customs import side. An import VAT would arise in that case, but again, potentially postponed import VAT accounting could be opted for in the customs declaration, which might be helpful in terms of managing the cash flow. So that's one option, which again is there's quite a lot happening there, quite a lot of VAT things that need to fall into place, and I suppose EORI numbers is also relevant there as well. The alternative is that you move the goods under customs transit procedures, and again, effectively this will suspend the VAT charge until such times as the goods are released from transit in GB. So what that would mean in simple terms is that the Northern Ireland supplier would charge UK VAT as a domestic supply, and the Republic of Ireland movement in between is sort of ignored for VAT purposes because the goods are under this transit procedure. So I think that's where I'm going to leave it at this stage, and I'll pass you back to Deirdre to pass you on to Colleen. Thank you.
Thanks a million, Frankie. It's very, very clear that there's a huge amount to take in for a business. And just for anybody on the call or the webinar today, these slides will be available and we'll be coming out to you after the webinar to ask you what you want to see more of. So appreciate that this is an overview, and we will build on this as we move forward. But thank you so much, Frankie. And without further ado then, Colleen will help us through the next VAT side, which is trading goods and trading services and the cross-border elements of that. So Colleen, obviously said you is a manager with PKFPM Accountants Limited, and I'm conscious of time as well, so I'm going to pass you very quickly over to Colleen, who will keep everybody right today. Thank you. Just need to get you your sound, Colleen.
Sorry, Deirdre, always helps if you come off mute. Apologies, guys.
That's perfect.
Perfect. As Deirdre mentioned, my name is Colleen and I am a Brexit manager in the PKFPM Brexit Centre of Excellence. And today I want to begin by having a little look initially at the post-Brexit VAT treatment of the supply of goods, and then move on to look at the post-Brexit VAT treatment of the supply of services. So when I look at the supply of goods, I will focus very much on the VAT treatment of the supply of goods between Northern Ireland and the Republic of Ireland. But important to note at the outset that that will equally apply to the supply of goods between Northern Ireland and other EU member states. So one of the most frequent questions that we receive from our clients is, if I'm a Northern Ireland based business supplying goods to businesses in the Republic of Ireland, and vice versa, how do I treat that transaction from a VAT perspective? And the answer is that much remains unchanged as a result of Brexit. So the supply of goods to VAT registered business customers will continue to be treated as an intra-community supply, with the VAT registered business customers self-accounting for the VAT arising, as was the case prior to Brexit. Similarly, if I'm supplying goods from Northern Ireland to unregistered consumers in the Republic of Ireland, the distance selling rules will continue to apply. And what this means that if my sales to the Republic of Ireland are below the distance selling threshold of €35,000, then I continue to apply UK VAT. And where my sales exceed this distance selling threshold, I begin to apply ROI VAT rules. Businesses throughout Ireland need to begin to prepare for the introduction of significant EU e-commerce VAT reform, which will be introduced in July 2021, and which will effectively abolish the distance selling thresholds and result in the creation of an EU-wide VAT return, referred to as the one-stop shop. And important to note at this point that although Northern Ireland remains within the UK VAT regime, the EU rules for goods will continue to apply. And trade between Northern Ireland and other EU member states, where that trade relates to goods, will now be governed by the provisions of the Northern Ireland Protocol. And as Frankie mentioned, it's not just businesses that are located and established in Northern Ireland that are covered by the provisions of the protocol. So a business will be deemed to be trading under the Northern Ireland Protocol if you're a VAT registered business and your goods are located in Northern Ireland at the time of sale. You receive goods in Northern Ireland from VAT registered EU businesses for business purposes, or you sell or move goods from Northern Ireland to an EU country. So many businesses with BT postcodes that are recognised and registered as trading in goods will have been automatically identified by HMRC as trading under the protocol. If you're concerned as to whether you've been identified, you can self-identify with HMRC via your government gateway account. And because of the unique position of businesses trading under the protocol, from the 1st of January, they've been recognised by way of an XI VAT number. And your XI VAT number is essentially your GB VAT number, with GB replaced by XI. And again, if you're concerned as to the validity of your XI VAT number, you can verify this by way of the European Commission's online VIS VAT number validation tool. And it's really essential that Northern Ireland-based businesses who are trading with businesses in the Republic of Ireland or elsewhere in the EU provide their XI VAT number to their suppliers and consumers based in the EU. For Republic of Ireland-based businesses, it's equally as essential that you reach out to your Northern Ireland-based consumers and suppliers and obtain their XI VAT number. So the next slide is a very important one. And what it outlines is the major implications of the Northern Ireland Protocol from a VAT perspective. And this is potentially best demonstrated by way of contrasting the post-Brexit VAT rules for trading goods between Northern Ireland and the Republic of Ireland, where the protocol applies, and trading goods between the Republic of Ireland and GB. So we've already referenced the fact that for trade between Northern Ireland and the Republic of Ireland, the inter-community supply provisions and the distance selling rules will continue to apply. In contrast, if I'm an ROI-based trader and I'm supplying goods to consumers in GB, this is now considered an export and an import for VAT purposes. An import VAT is payable on the movement of the goods into GB. And depending on where the ownership of the goods transfers and the particular Incoterms used, this may result in a UK VAT registration requirement for ROI-based businesses. Similarly, if I'm an ROI-based business and I'm selling online to consumers, unregistered consumers in GB, if my goods are located outside GB at the point of sale and the value of my consignment is below £135, I'm required to register and account for UK VAT at the point of supply. If we move to look at EU VAT simplifications, such as triangulation and the simplification for call-off stock, these simplifications are used to ensure that EU-based businesses can trade with other businesses in other EU member states without having to register for VAT in those EU member states, with VAT ultimately accounted for by the end customer. Post-Brexit, these simplifications will continue to be available to businesses trading under the Northern Ireland Protocol, but they won't be available where goods pass through GB or where a GB-based party is a party to the transaction. And what this means is that this will create a registration requirement not only for GB-based businesses in the EU, but also for EU and ROI-based businesses in GB or in the UK in many instances. And finally, if we look at EU systems such as the Electronic VAT Refund System or EVR system. So prior to Brexit, this allowed EU-based businesses which incurred VAT in other EU member states to reclaim that VAT if they weren't VAT registered in that EU member state. And that VAT reclaim could be claimed by way of an electronic submission to HMRC. As Frankie mentioned, going forward, the EVR system will be available to Northern Ireland-based businesses trading under the protocol, where VAT is incurred in respect of goods only and where certain conditions are satisfied. In contrast, GB-based businesses will no longer be entitled to use the EVR system. And this means that ROI or EU-based businesses will also no longer be entitled to use the EVR system in order to reclaim VAT incurred in GB where that trader is not VAT registered in the UK. And this will require ROI-based businesses to familiarise themselves with new processes in order to reclaim VAT incurred in GB. So what we see if we look at these points as a whole is that the trade between Northern Ireland and the Republic of Ireland maintains much familiarity with the pre-Brexit trading position, whereas there are fundamental changes to the way in which EU-based businesses will trade with GB going forward. And I wanted to finish this section of my presentation by having a little look at some essential steps that businesses based throughout Ireland need to take in order to continue to trade in goods post-Brexit. We've discussed the absolute necessity for businesses to both supply and acquire XI VAT numbers where relevant. Businesses also need to consider the impact of Brexit on their EU reporting responsibilities. So for Northern Ireland-based businesses, they're continued to required to complete the VAT returns, Interstat returns, and EC sales lists in respect of the supply of goods only. For ROI-based businesses, they must continue to complete the VAT return, Interstat return, and fees return. Important to note that trade between Northern Ireland and the Republic of Ireland needs to continue to be reported on these EU returns, but non-EU transactions such as supplies to GB can now be excluded from the returns. Businesses need to ensure that they've prepared for the really fundamental EU VAT e-commerce reform, which is coming down the tracks in July 2021. And businesses need to consider any VAT systems updates that are required as a result of Brexit. So because of the rules that we've just discussed, ROI-based businesses may need to distinguish between Northern Ireland and GB in their ERP systems. Invoice templates may need to be updated to reflect XI VAT numbers, and tax codes, which are used to record transactions within accounting systems, may need to be updated to reflect the UK's position as a third country. So if we move now to look at the VAT treatment of the cross-border supply of services, important to note at the outset that although the Northern Ireland Protocol covers the supply of goods, it does not cover the supply of services. But what we see from this table is that much has remained unchanged. So if we look at the supply of services between Northern Ireland and the Republic of Ireland, or between the Republic of Ireland and GB, as was the case prior to Brexit, where these services are supplied to a VAT registered business customer, the business customer can continue to self-account for VAT. Where the services are provided to a private, unregistered customer, the guidance indicates that these services will continue to be subject to VAT in the place where the supplier belongs. Really important to note that there are a number of exceptions to this general rule, and so it's essential to view every transaction on a case-by-case basis. For traded services between Northern Ireland and GB and Northern Ireland, these will continue to be treated as a domestic supply of services, with UK VAT applied where relevant. And for supplies of services between rest of the world and Northern Ireland and Republic of Ireland and rest of the world, this will maintain much familiarity with the pre-Brexit position, with the pre-Brexit rules continuing to apply. However, traders do need to be aware that there are significant changes to certain aspects of the VAT treatment of the supply of services post-Brexit. So firstly, the VAT MOS scheme is no longer available to UK traders, and this includes Northern Ireland-based traders. So where Northern Ireland-based businesses supplies digital services to VAT unregistered consumers in the Republic of Ireland or other EU member states, they will either be required to register for ROI VAT or register for the non-union VAT MOS scheme. Similarly, ROI-based traders supplying digital service to unregistered consumers in the UK will likely be required to register for UK VAT. If we look secondly at the use and enjoyment provisions, for the purpose of these provisions, the UK is now recognised independently from the EU. So for supplies covered by these provisions, such as the letting on hire of goods, where the place of supply of those supplies would be the UK, but the goods on hire are effectively used and enjoyed in the Republic of Ireland, this can create a registration requirement for the NI business in the Republic of Ireland that wouldn't have existed prior to Brexit. Thirdly, if we look at the place in which VAT is payable, where services of a professional, technical, financial, intellectual, or other intangible nature are provided to unregistered consumers, the place where VAT is payable is now the place where the customer belongs. And this represents both a departure from the pre-Brexit rules and a departure from the general B2C rules. So this will likely have an impact on the supply of services such as accountancy, legal, tax and consulting when supplied to unregistered consumers. And finally, and to finish, I suppose, on a high note, Brexit and the change in the place of supply rules and the recoverability rules will likely have a potentially positive impact on the VAT recovery position of financial services businesses. So previously, ROI or EU-based businesses providing certain financial services within the EU were restricted as to the VAT that they could recover on their associated costs. From 1 January, the supply of financial services from the Republic of Ireland to GB is now considered as being provided to a non-EU country. And this is likely to result in a boost to the VAT recovery position of ROI-based businesses providing financial services to GB customers. Similarly, UK-based businesses making specified supplies to EU customers will also now be entitled to recover VAT on those associated costs. So that really is a whistle-stop tour of the 2021 VAT landscape. For now, I'm going to hand over to Deirdre and happy to take any questions during the Q&A.
Thank you so much, Colleen. That was really good, and the tables are brilliant as well. And again, we'll have the slides for everybody. And I'm also just want to be very conscious. I know time is precious for every business on this call today, and we have covered a lot, and we still have more to cover. So we're probably going to run over here. But as then I just want you to know that we'll come back to all of this, and our speakers have agreed to come back another day and do the same again for us. And we'll have a separate session on VAT and a separate session on the customs as well. So I'm going to pass you over to Elinor and Ray. We're going to take you through the revenue section, and we'll briefly do a few questions at the end, but we'll do our best to what we can with the time that we have. So thank you.
Thank you very much for taking the time to speak to us this afternoon. And yes, we will try and go through this quite quickly, but conscious there is a lot of material. So as Deirdre said, we'll go back to it in the future. So I'm just going to set out a bit of kind of context about the protocol, and then we'll go into what this means from the perspective of customs processes. We'll talk to both what you need to do in terms of an interaction with HMRC for where goods movements go through Northern Ireland, and Ray will also talk about the interactions with the Irish revenue systems and how those things fit together, particularly when you're moving goods that involve Northern Ireland, Great Britain and the Republic of Ireland in the same goods movement, which is where it can get quite complex. So should we go to the next slide? So the protocol, as people will be familiar with, means that there is no hard border on the island of Ireland, and that means from a customs perspective that there's no physical infrastructure, no checks or processes, no customs duty and tariffs charged on goods that move between Northern Ireland and the Republic of Ireland. What that means instead is that a lot of the customs processes that might otherwise have been done as goods move across the land border are done as goods move between Great Britain and Northern Ireland, and that's a lot of what we'll talk about today and what that means in terms of good flows. But it's just worth remembering as we go through that actually on the island of Ireland, once the goods are on the island, then there's nothing further to do from a customs perspective, although taking into account what other speakers have talked about in terms of the VAT impacts of those types of movements. So should we go to the next one, please? Okay. So recognising that this is particularly challenging for businesses, the UK government has set up the Trader Support Service, and this is a free of charge service that is aimed at UK businesses and traders who are moving goods between Great Britain and Northern Ireland to assist them with both understanding those processes but also making the required declarations that we're going to talk about. The Trader Support Service offers a real range of different education and support materials in terms of guides, webinars and other materials, and it's worth accessing the Northern Ireland Customs and Trade Academy website to be able to look at those materials if you are moving goods between Northern Ireland and Great Britain, even if that's via the Republic of Ireland. It also will make declarations on behalf of a business, and it has a service set up to do this. You have to be registered with the TSS in order to take advantage of their system. But that registration is a simple matter of going onto the website, registering, and then the services they offer are, as I said, free of charge. So anybody who is impacted by these processes and needs to interact with HMRC systems should consider registering with the Trader Support Service and looking at the support that it can offer to you. We go to the next, please. So the first goods flow that I'll talk about is the direct movement of goods between Northern Ireland and Great Britain. And we start with this one because in some ways it's one of the simplest. So for goods movements from Northern Ireland to Great Britain, the protocol guarantees businesses what's called unfettered access to the rest of the UK markets. And this is a phrase that you might have heard about, and this is what it refers to. It refers to a Northern Ireland business being able to access and sell its goods in the rest of the United Kingdom without having to face new processes. So for the vast majority of goods movements from Northern Ireland to Great Britain, there are no new processes, there are no customs declarations, there are no tariffs and no checks that are required. There are some small exceptions to this, which were part of what was agreed with the EU Commission, and these relate to certain types of businesses who do need, certain types of goods movements that do need customs declarations, which quite a specific list of goods movements, and it's generally those where goods are subject to international conventions that require additional licensing and checks on those goods movements. So there is a list on gov.uk. There's only 14 types of goods within those lists, and they are things like CITES goods, ozone depleting gases, Kimberley diamonds, and things like that, that if you are moving those types of goods, you will probably be aware already that they are subject to these international conventions, and therefore more processes are required on their movement. In addition, declarations are required for movements of goods that are under customs special procedures that involve suspending customs duty, because we need to be able to track those from Northern Ireland into Great Britain. Should we go to the next slide, please? So we're going to now talk through the slightly more complex bits, which is all the different trade flows that involve movements between Great Britain, Northern Ireland, and the Republic of Ireland. So there's a number of different choices in some of these that it's worth going through and understanding as we do this, because in lots of cases there's more than one way of doing the same thing, and the best option for a business will really depend upon the business itself, what it's doing, and its kind of size and complexity as well. So if we start off looking at the Northern Ireland to Great Britain flow, but where it goes via the Republic of Ireland. So if we think about it, this one is, if you go direct, there's the unfettered access provisions, which means for the majority of goods, they don't have to do any processes. If you move the goods doing it the same thing, but they move via the Republic of Ireland, you are moving those goods into the EU and then out of the EU again, and therefore you need to interact with processes and custom systems in a different way. And there's two options for how you might choose to do this. And as I said, different ones will suit different businesses. There's no right and wrong answer in this regard. The only thing I will say is, if you are going to use transit, a business using transit will need to either have the authorizations themselves or use an agent who has the necessary authorizations to be able to do transit movements and have a guarantee for transit movements as well. So there is a consideration with transit movements that may not apply in others for other types of options in this area. So I will talk about this from an HMRC perspective, and then I'll hand over to Ray, who will talk through these same processes from the perspective of the Irish Revenue and what you need to do for interactions with them. So if you were to do this goods flow using transit, the transit movement would be started at an authorised consignor or an office of departure in Northern Ireland using the Northern Ireland NCTS system. So this is an XI prefixed version of the NCTS system, which is for use in Northern Ireland and connects into the NCTS system that is used both in Great Britain and across the EU. So that transit movement is started. Ray will cover off the bit about how the exit through the port of departure in Northern Ireland in just a minute. But then that transit movement, when it's ended at an authorised consignee or an office of destination in Great Britain, the transit movement is released, because a transit movement allows goods to move in duty suspension and therefore not need to have customs declarations. At that point in time, an import declaration would be required to import the goods into Great Britain, because they've moved into Great Britain via the Republic of Ireland, and therefore that import declaration would be required. However, a business can take advantage of the staged controls approach that is in place for goods imported into Great Britain, which means that you can use the delayed declaration process, which means that the majority of your declaration requirements are delayed until July. In addition, when the declaration is made, a business can take advantage of an override of any tariff that would otherwise be chargeable on that goods movement, and reflects that that is a goods movement between Northern Ireland and Great Britain, and therefore no tariff is chargeable on it. So that's the option using transit. If you prefer not to use transit, there is also an option using an indirect export process. This is a process that TSS supports. So if you are a Northern Ireland business using this process, you can use the TSS, and it will do this on your behalf free of charge. So what the indirect export process does is it makes an export declaration in Northern Ireland as an indirect export, which just means that you're going to leave via a port that is not in the same country as where you make the declaration. So it will show an exit, port of exit in the Republic of Ireland. That export declaration is made into HMRC systems, but as Ray will go over, it is then exited in the Republic of Ireland. Again, once the goods arrive in Great Britain, they will need to make that import declaration into Great Britain in accordance with the stage controls approach that is in place for goods being imported into Great Britain. And again, the override of the tariff is also available to reflect the fact that those are goods coming from Northern Ireland into Great Britain. So as I said, TSS will take care of a lot of that on your behalf, but Ray will talk to now the next slide, which is the Irish revenue interactions of those same processes.
Thanks, Ellie. Yeah, I'll just briefly go through the requirements then, using both, as Ellie described, the two different options that Northern Irish businesses could take. So if you're using transit, as Ellie has covered, you will use the XI NCTS system. This will give you a master reference number, and the port of exit is in Ireland, so you're leaving the island of Ireland through an Irish port, so Dublin or Rosslare. That MRN, that master reference number, actually needs to be added into what's called a pre-boarding notification. So this is a new aspect, that pre-boarding notification. You can complete it on the revenue website there. You enter the MRN details on the declaration on the pre-boarding notification. So again, anyone within the supply chain can complete this pre-boarding notification, but it must be done in advance of arrival at the ports. So the ferry operators will not allow you on if that pre-boarding notification is not in the correct status. So again, it's important that if an agent is completing the MRN or the transit declaration and has the MRN, that if it's someone else that's completing that pre-boarding notification, that information must be shared to ensure that the vehicle boards the vessel. So again, there's lots of information on that revenue.ie/RORO explaining further details on the pre-boarding notification, but that's a step that needs to be taken. And similar then in the indirect export. So again, if the export declaration is completed or started in HMRC systems, it will be recognised in revenue systems as an indirect export. So the port of exit in this case would be Dublin or Rosslare again. That MRN needs to be added into the pre-boarding notification again. Again, similar to above, you need to ensure that the MRN is shared with the person completing the pre-boarding notification. That pre-boarding notification needs to be done in advance of arrival at the ports, or else if it's not in a valid status, they will not be allowed aboard the ferry. So again, an awareness around that. The only difference then between the transit and indirect exports will be that the exit confirmation is completed electronically. So again, if that indirect export MRN is on the pre-boarding notification, revenue systems will actually update the exit confirmation back into the export control system, which will update it to exit it on your declaration. So you'll have a full record that the export declaration has closed off on the system itself. So that gives you a quick overview in relation to the revenue requirements. And I'll just jump back to Ellie, I think now.
Thank you. So we'll now start considering the flows going in the other direction. So we're now looking at going from Great Britain into Northern Ireland, and we'll start with the kind of the direct flow, and then we'll move on to the indirect flows afterwards. So the protocol does require, as I briefly mentioned earlier, that there are import declaration requirements for goods moving from Great Britain into Northern Ireland. This is a new requirement under the protocol, and is one of the reasons that the UK government set up the Trader Support Services to help businesses with these new customs processes. So the process is required to involve both an entry summary declaration, which is also known as a safety and security declaration, and also an import declaration made into HMRC systems. So the TSS supports that by doing those on digitally, and there is an online interface that businesses can use to interface with those systems and to provide the data that is used to make those declarations. But that declaration process is required, and it does a number of things, as well as principally ensuring that tariffs are not paid where they don't need to be, so on internal UK trade, but allowing the charging of tariffs where goods are either going onwards into the EU after they've been into Northern Ireland, or where they are at risk of doing so. And I'll talk more later on in this session about what we mean by at risk and when goods might be considered to be at risk on entry to Northern Ireland. But it's first worth just thinking about the process and what that means. So the system that the TSS uses is a two-part system, whereby they take advantage of customs simplifications to do that. And if we go on to the next slide, we'll talk through kind of what that process looks like. So the process using TSS to move goods from Great Britain to Northern Ireland is a purely electronic service using the TSS system, which either has a portal or an automatic API upload to do it. It generates what's called a simplified frontier declaration before the goods move, and also the entry summary declaration. So it's doing things on behalf of both the business moving the goods and the person moving the goods, who is usually the person who would have the responsibility to make an entry summary declaration. The TSS service puts those declarations into HMRC systems and returns back the MRNs, the movement reference numbers, that are needed to demonstrate that the goods have had those declarations made before they move. So usually this starts with the haulier. The haulier will input data into the TSS system. The TSS will use that to do the simplified frontier declaration and the safety and security declaration, and will provide back to the haulier the MRNs. The MRNs use that data to populate what's called the goods movement reference number. So this is part of a new system that HMRC has put in place, which is called GVMS, which is the Goods Vehicle Movement Service. It's a very similar system to the system that Ray has talked about, which is the pre-boarding notification system that is used by the Irish Revenue. It's a very similar system to that, where MRNs for different movements that are on a particular truck are entered into that system first in advance of the goods moving, and is used to carry out checks and process the declarations while the goods are actually physically moving on board the ferry. So it is a very similar system. It is separate and different though, because it's used across all of the UK. So all interactions between with goods coming to and from the UK. So it is therefore a different system. So from the perspective of haulier, it is more complicated because they will have a number of systems they might need to interact with that do similar things. So the haulier will populate the goods movement reference number, and they will get a single reference number that accounts for all of the declarations that they have for everything that's on board the truck. That has to be presented to the ferry operator before the truck seeks to board a ferry in Great Britain. And in a lot of cases, it's done when the truck is booked onto a ferry. It can be done at check-in if needs be, but most of the ferry operators on the Irish sea routes prefer it to be done at booking. So that GMR is presented, and then that is passed to HMRC while the ferry is moving, and that is used to process the declarations and identify any goods that need to have checks on arrival in Northern Ireland. So that's the bit of the process that happens as the goods move. There's a second part of that process which takes place later on once the goods have arrived at their declaration. So, at their destination. So TSS will contact a business whose goods have moved using their service to get additional data for what's called a supplementary declaration. And businesses who are already interacting with the TSS will be familiar with this, because it's a process that has recently started and businesses are being asked for data for their supplementary declarations. And what the supplementary declaration does is effectively is one half of a customs declaration. So a frontier declaration and a supplementary declaration together make up an entire import declaration. So it's merely the same, it's a declaration but in two pieces. The supplementary declaration will include quite a lot of information about the goods, the value of the goods, and a lot of other information such as that. It's also the point in time where, if a tariff is payable on that goods movement, that is charged. And it is the point in time where the person moving the goods needs to make the determination of whether the goods are at risk under the processes that are in place for goods movements into Northern Ireland. If there is a tariff payable, it is at this point in time that TSS will collect that payment and pass it over to HMRC on behalf of the business using the TSS system. Okay, so that's just an overview of how it works using TSS. Those people who are already engaging with TSS will be familiar with this, because you will probably have seen this set out in a lot more detail in their sessions, their webinars and seminars, and is available as an overview package on the Northern Ireland Customs Trade and Academy website as well. Should we move to the next slide?
Ellie, just Deirdre interrupting here. Sorry, hopefully I'm not rude, but I just wanted to do a little check-in on on the attendees here, because I appreciate we've got very high numbers, and just letting everybody know we're slightly overrunning in our time here, but we do have some really valuable slides left, which are very important as well. So thanks everybody for their patience, and what we don't get covered in today's session we'll definitely do again. So I just wanted to give you a bit of a time check. Thank you.
Thank you. And really appreciate people staying on if they can. So if we move on then to, if goods go from Great Britain to Northern Ireland, so same start and end point, but they go via the Republic of Ireland this time. And this is a different situation because in this scenario, you will also need to interact with the Irish revenue systems because the first movement of the goods is into the Republic of Ireland, and therefore the process is different. So I will hand over to Ray to cover over the process if goods are exported from Great Britain and then imported directly into Ireland, and then we'll consider the second option, which is if you're going to use transit.
Yeah, thanks, Ellie. Conscious of time, Deirdre, as well. So I'll just keep it, I suppose, at a high level in terms of the, again, it's two options, and it's a business decision really in relation to which option they take. So if you're moving goods from GB with ultimate destination in Northern Ireland, you can actually clear the goods in Ireland on revenue systems. What you required is an entry summary declaration. That's the safety and security declaration that needs to be submitted to our own revenue systems. It's usually the haulier that's responsible for that, but again, ensure that it is completed because you will not be allowed board the vessels without the entry summary declaration being completed. An import declaration is also required to be submitted then, and this is to cover all the goods on board. So again, it's a reminder that both those declarations need to be done in advance of departure from GB, because both those MRNs, the master reference numbers, need to be added into that pre-boarding notification, so the ENS and the import declaration. Once the goods come in then, the goods are cleared by customs. So again, it's cleared on Revenue's customs system, the automated import system, and this includes any controls or payment and duties. So once it has cleared customs or any other state agency checks, the goods are free to move in free circulation, so they can move to any point within Northern Ireland or Ireland. So again, it's just to be aware of that. There's no further customs requirements as a result of the protocol. The second option then would be in terms of the transit. So again, an awareness around that, it's moving, the goods are going to be cleared in Northern Ireland rather than Ireland. So Ellie will come back in a minute, just go through the TSS process, but it's similar enough in terms of the revenue requirements that you do require that entry summary declaration again. And then you require, rather than an import declaration, you require the transit declaration, which would be submitted. So those two MRNs will be added onto that pre-boarding notification. If they're added into it, the transit declaration is in it. The Office of Transit functions for Dublin or Rosslare will be completed electronically through revenue systems. So again, an awareness around that. Any SPS controls must be completed. So it's important to remember that if you're moving goods of agri-food, to be aware of that, and the pre-notification requirements to Department of Agriculture, Food and the Marine. So just an awareness around that, and then the goods can flow through the ports using that electronic notification for the Office of Transit functions and move to the end destination in Northern Ireland. So Ellie can come back in relation to the different steps around the transit process there.
Yeah. Thank you very much. So yeah, so the TSS does have a service that it offers as part of its suite of services that is doing this goods movement as a transit movement. So the TSS will offer the transit authorization, it has the transit guarantee, and will set up the transit movement on behalf of the business moving the goods. The reason for offering this is if you clear the goods in Ireland on arrival there, the EU's tariff will be chargeable unless the trade agreement between the UK and the EU could be used to claim the preferential tariff rates of 0 that are available within that. What clearing the goods in Northern Ireland using the transit process means is that the business retains the option to declare goods not at risk, as they would be able to do if the goods move directly from Great Britain into Northern Ireland. So it allows that decision to be made, which gives a business more options for mitigating the tariff charges if the goods are going to Northern Ireland. So the TSS would do this process. It will start the transit movement and provide the transit MRN to the business moving the goods. It will also submit the ENS into the Irish Revenue's ICS system and provide the MRNs for both of those to the person moving the goods so that they are able to complete the pre-boarding notification that Ray talked about. Once the goods arrive at the office of destination or an authorised consignee location in Northern Ireland, the transit movement can be will be released. And then TSS will also then make the import declaration that is required into HMRC systems on behalf of the business. And as I've said, at that point in time, the business will have the option of making the at-risk determination, and as well as being able to use the trade agreement, they could also use the not at-risk declaration process in order to mitigate the charge of any tariffs that on the goods if they are going into Northern Ireland and staying in Northern Ireland. So that's just a slight difference if you use that process over the other one. So if we go to the next process. So the next one we were going to look at is going from Great Britain to the Republic of Ireland, but this time going via Northern Ireland. So this is what would, if you did this directly, you would just do an export from Great Britain and an import into Ireland. But in this case, the business decides to go via Northern Ireland because that is more convenient for them. That route might be better for them for any one of a number of reasons. And again, you've got two options. There's always two options in these things. So you've either got doing the clearance in Northern Ireland or doing the clearance in the Republic of Ireland, the latter using transit. I'll speak to the first and then I'll pass to Ray to the second. So if the goods clear in Northern Ireland, this is the same process in terms of interacting with systems as if you were moving goods directly from Great Britain to Northern Ireland. You still do the clearance in Northern Ireland, even if the goods are moving onwards into the Republic of Ireland. So in the same way as with the direct movement, the ENS would be into the Northern Ireland ICS system, which is an HMRC owned system, and the import declaration would be made into CDS, which is the same for a direct goods movement from Great Britain into Northern Ireland. The TSS can assist with these processes. It does require there to be a Northern Ireland business involved in that process, as well as the importer in the Republic of Ireland, but it can assist with this process if that would be helpful. Or there are a number of customs agents who can also assist with this process and will have the necessary accesses to systems to be able to support Republic of Ireland importers with this process. So the goods will be cleared in Northern Ireland and all the relevant kind of clearances done there, including SPS checks if the goods are agri-food goods. And there would be no further processes to move the goods onwards into the Republic of Ireland. The point to remember with this goods journey is because these goods are destined for the Republic of Ireland, they wouldn't be able to be declared not at risk on entry to Northern Ireland because they are going into the Republic of Ireland. They're not just at risk of going to the EU, they are going to the EU. However, a business could look to the UK-EU trade agreement to claim the preferential tariff and therefore have the zero tariff applied to the goods if that were available to the type of goods and the origin of the goods that they're moving. So it's the same. It effectively puts it in the same position as if you directly imported into the Republic of Ireland. The main difference being you're interacting with HMRC systems to do your import process rather than the Irish revenue systems. Ray, did you want to talk about the transit option for that route?
Yeah, I can just go through it again briefly. In terms of what Ellie has covered already, that ENS is still required again coming into Northern Ireland. So then the option will be if you're not going to clear the goods in Northern Ireland, it's using transit declarations. So the transit would actually be raised in the GB's NCTS system. So it's the opposite part will be in GB. Again, it's a reminder that you would need access to the transit guarantee to allow you to create the transit declaration. So an awareness around that. If it's your UK supplier that's or GB supplier that's completing the transit declaration in GB, that they need access to those guarantees. And then destination will be listed as an authorized premises in Ireland. Again, GBMS system would need to be completed with the GMR, with both the ICS and the transit MRN in it. Again, there's the opposite transit functions within Northern Ireland, and any checks for those agri-food products would need to be carried out on arrival in a Northern Irish port. They can't be, I suppose, pushed into Ireland. So again, it's an awareness around the type of products that you are bringing in. Once the goods can move through Northern Ireland, the transit is actually ended then in authorised premises in Ireland, and this is done by the submission of an import declaration to Revenue's AIS system. And again, that takes account of any duty that's paid to Revenue. So again, it's an awareness around the two options for Irish businesses as such, that you can clear the goods in Northern Ireland. There's obviously requirements in relation to having access to agents, paying duties or potential duties or VAT to HMRC. And then on the transit option, the requirements around the access to the guarantee and the steps taken in that, and obviously the authorised premises in Ireland. So again, it's a business decision for which option you take, but it's these slides, I suppose, outline the different requirements under each step. So I think it's useful to have them.
Sorry, it's Deirdre again. I would be a real torture to you guys. Thank you so much for all of this information. Again, I'm really conscious of time, and I know we've a lot of people here. We've still a lot of participants on, and I wondered, I know there's still quite a few slides to get through. If we could even just go through the headings of each one, and just we'll give a commitment to everybody here on the call that we're going to come back and we'll do all this again for you guys with a little bit more time for you. So if I could just sort of mention that, I suppose, to both of yourselves, sort of pick out the key points here, and we'll maybe then try and even get room for like 1 or 2 questions at the end. But as I say, we'll come back to all of this.
Yeah, I can go very quickly through this. This goes moving from Ireland to GB via Northern Ireland. So the reverse of what we just talked about, but obviously the requirements and the options are the same. So you're either using transit in Ireland and raising the declaration in Ireland as a transit declaration and an office of destination in GB, and then the indirect options there. There's actually a link at the end of this presentation anyway that has the indirect export details, so that can be used if we want to skip on quickly. But again, obviously the Q&A session is important, so I'll skip on to the next slide then. So I think
yeah, and the thing we were going to talk about next was going to be the free trade agreement and the process for determining whether goods are at risk. Deirdre, if it would be preferable, it may be better to do that as a wholly separate session, given that it is quite detailed. And let's just focus today on questions about the processes, and we'll come back and do a session on this section later on, if that would make sense.
That's a great plan. Great plan. Thank you, Ellie.
Don't know, Ellie, if you want to look at the risks.
It's probably best not to. So all of this is about at risk and determining whether tariffs are due. So it's probably best we do all of it via a separate session if we're going to kind of go into that.
Yeah.
Okay.
Okay, I'll stop the sharing the screen, Deirdre, there.
Look, very conscious. That was hard work as well. Like, I know that you've had a lot of information to deliver across to businesses. Even myself coming at it with GVFS and pre-boarding numbers and all of TSS and all of the acronyms, it's hard to get around for businesses, and I think it's just going to take time basically to understand the processes, and we'll need to repeat and repeat till we get to understand it ourselves as a business. And I really appreciate the hard work and effort that you've done in there to get those slides and the messages across to businesses, and I appreciate every participant who has been sitting here and giving up their time just to hear all this as well. I definitely hope that this was of value to you. I'm just very conscious that we have a very short period of time here, and you do have a commitment that we're going to come back to you with questions and answers. So what I'm going to do in the interest of time, I'm going to take 1 question each for each speaker. Okay. I know it's not what you want today, but we'll make this better at a point in time in the future. So to give Elinor and Ray just a little bit of breathing space, I'm going to go to Frankie, if Frankie is still here, and maybe just ask Frankie a question, which I think is probably one that is coming in quite popular, and it may indeed cover off some of the things that have been asked. I've seen this question asked actually a few times. So Frankie, are you here? I wonder, are you still here?
I'm here, yes, and I'm unmuted as well.
Right, well, I'm going to call this question out to you because it's just right. So let me just go down here. So we act as a depot for a GB manufacturer, and we supply some of their products to their ROI customers. The invoice is raised by a GB company to the ROI customer. Incoterms would be DAP. Are there any VAT implications the GB manufacturer should be aware? Maybe this is a bit complex. A no VAT query, if you can assist. Is there a requirement by either a GB supplier or an ROI customer to make customs declarations?
Yeah, okay, I'll try and give a very quick answer, but it is quite involved. I suppose the customs bit, which Ellie and Ray could answer much more better, but I think the answer to that is yes, there will be customs obligations as they've covered, and depending on what way you're moving those goods under transit or not. So I suppose there will certainly be customs implications. In terms of VAT, again, there will be the default position would be that UK VAT would be chargeable in relation to that. So it's import VAT arising, but the import VAT is accounted for as output tax, probably by the GB supplier unless you are using some sort of either transit procedure, or I suppose if the goods are moving from GB into a distribution hub in Northern Ireland and being held there, possibly in that case the GB supplier could say, I'm moving my own goods from GB to NI, account for it in their own VAT return, and then subsequently the goods are moving from NI distribution hub to ROI customer. So that's a intra-EU supply effectively for VAT purposes, so probably zero rated intercommunity supply. So there's probably about 3 or 4 different variations of that depending on how they move those goods. So not a simple answer.
Thank you. And it actually is a really good way of outlining just how much choice and complexity there is here. And again, it's going to take businesses a while to manage through their supply chain options. So I'm going to very quickly move on. Colleen, another question here, which is so if I am a Northern Ireland based trader, can I continue to use a drop shipping model where my goods are delivered directly from my supplier in one member state to my end user in another member state, for example, a supplier an ROI to an end customer, say in France? It's quite complex.
Thanks, Deirdre. It is quite complex, but a really hugely popular question that we're getting from a number of our clients. Kind of, I suppose, shows the complexity of kind of international trade. Very quick answer: triangulation will continue to apply for the movement of goods between 3 different member states in the EU. And so that simplification will allow the end consumer to account for VAT, as would have been the case prior to Brexit. Just if GB is involved in that transaction, that the movement of the goods from GB into the EU will attract import VAT. And so it's really important that businesses work with their customers around the kind of commercial, I suppose, implications of this and who will be responsible for the import of the goods, both kind of from a customs and a VAT perspective. So some changes if the goods are moving from GB into the EU.
Okay, thank you so much. Quickly then, I think maybe perhaps Ray, so we're based in ROI. Our UK suppliers export small parcels of goods to us using FedEx. Even though the country of origin in the UK and no duty should apply under the free trade agreement, FedEx seem to have adopted a policy whereby they are applying duty in order to expedite delivery of these goods. Is there a mechanism that will address this in the future, and is there any way to get a refund of the duty paid? Number 1. I don't know if you remember this all, where a shipment is red routed by the Irish Revenue, what can we as the importer do to get the information on why it was red routed, and how long will it take for release of the goods? Brackets, our customs agent is unable to get any information on our behalf. Do you need me to go through that in parts, Ray, or?
No, it's okay. I'll take the first one on the kind of the tariff and the application of under the TCA, the preferential duty rate. The difference, you need to claim the preferential duty rate on each customs declaration. So the facts that, I forget, was it DHL or whichever express carrier it was, submitted the declaration, it actually doesn't make a difference in terms of the processing if they're putting in the declaration, but they seem to say it's speeding up the process to put in the declaration detail or the duties. But if they enter in the correct details to claim the preferential origin, then it shouldn't apply any duties. So again, it's an awareness around that. It could be the information the supplier is giving in GB to make sure that they're sharing that information that it's UK origin, and they have the statement of origin requirements around that to ensure that DHL are completing it. In terms of getting the refund, you would actually have to contact, I'm not sure if it was DHL, sorry, the express carrier to make the refund claim on that if you do have the proof of origin on it. In terms of the red routed, the agent should have access to the details of why it was stopped, because they're the ones that are doing the declaration and they get the message back from our system to give the reason for the routing for a physical check. More than likely, the majority of physical checks are linked back to state agency checks. So it's agri-food, health products, environmental health service, that type of thing. So it could be that. So just an awareness around maybe the type of products you're having.
Okay, we've got another one here, which might actually be a little bit similar, but it has slightly different. So my company is based in ROI. We're importing from the UK and Northern Ireland, so from 2 jurisdictions. Are other companies finding that couriers are not fully up to date in applying the customs compliance with delivering with supplies coming from the UK? Calculation of taxes and customs are not correct. We are finding this at the couriers, and we can't hold them to account for the customs documentation. How do we get customs declarations information off them? We're finding it very hard. I mean, is that?
We are getting queries into my own unit, the Brexit team, in terms of this, and it's an education for everybody, from businesses to revenue, HMRC, and to the courier companies on how to apply the rules. You should have access to the declarations from whoever's completing those declarations. If you're listed as the importer, you should have access. The key to it is if you can get your URI number on the customs declarations. If the URI number is down as an importer, you have access through ROS for anywhere where your URI number has been listed, and you could have access to the details then, so any duties paid and the MRN again, which can help you then going back to the relevant couriers or whoever's completing the declarations to follow up if you don't think you should have been charged.
Okay, thank you. And I have another one here. I'm not sure if this is Ray or Ellie. So how do we plug into the PVA system when in the ROI without having to set up a PVA account with a courier? What's the PVA?
That's actually linked back to the URI number. So your customs registration number needs to be listed on the customs declaration, and you need to be Irish VAT registered then to avail of the postponed accounting. PVA is the postponed accounting. So you need to have your URI number listed as importer, and you need to have a valid Irish VAT number. Once you have those two, and the declarant enters a 1A05 on the customs declaration, the postponed accounting will apply, and you just account for it in your normal returns then.
Okay, and just another one here then, just on VAT maybe. So there's been a lot of reference to getting registered in the opposite jurisdiction should you be registered. Can somebody tell me, is that a difficult thing to do for a business? How do you go about doing that? What requirements do you need in order to say, for example, get registered for UK VAT if you're based in ROI?
Yeah, I mean, and that is happening quite a lot, because I suppose if you're an ROI business that's selling into GB maybe under DDP terms, so you're gonna probably have that obligation to get the goods from Ireland to the GB customers' premises. So you're going to deal with the export and the import into GB, and then actually have an obligation to register for UK VAT. So you would be entitled to register for VAT on the basis that you're making the supply of goods once they're in GB onto your UK customer. So you would register under the normal basis, on the online HMRC system in that case. So you don't have to be established in the UK to register for UK VAT if you're making supplies of goods in the UK. So I suppose one note of caution is that it is taking quite a long time to get UK VAT registrations at the moment, because there is a very significant uplift in registrations because of these reasons. Businesses that never had to be registered for UK VAT are having to do that now if they're delivering DDP. So you probably need to give yourself plenty of time if you can get your application in as quickly as possible.
Okay, and finally, GB to NI, is there threshold value before Intrastats and EC sales lists apply, or is it for any goods movements? I'm not sure who wants to take that one.
So if you're moving goods from Great Britain to Northern Ireland, you are completing customs import declarations. That means you don't have to do EC sales lists or Intrastat returns for those goods movements, because you're providing more information, in fact, by making a customs declaration than if you were completing those requirements. In terms of businesses in Northern Ireland, they only need to do EC sales list and Intrastat declarations in respect of goods movements that they have between Northern Ireland and member states of the EU. GB-based businesses do have to still do Intrastat declarations for transactions they have with member states of the EU during 2021, while we have the stage controls approach in place for imports into Great Britain from the EU. So there are some ongoing Intrastat declaration requirements in the UK that will fall away in the fullness of time. But if your goods movement is solely between Great Britain and Northern Ireland, there's no Intrastat and no EC sales list there.
Brilliant. And just in the time, I know Denise has very patiently sat in there, and I must just say that for businesses who need help, there is help here. We've got a lot of experts on our panel as well in InterTradeIreland. And Denise, could you quickly pop in and let us know what supports are available to businesses who could maybe get a little bit more one-to-one advice on how to deal with these kind of issues? Are you there, Denise?
Hey Deirdre, just coming on now, just bear with me.
The joys of technology.
Absolutely. Zoom has just disappeared from my screen, would you believe? Just bear with me.
You probably know the supports anyway, Denise.
Yeah, no, absolutely. So here we are. I'll just quickly run over the Brexit Advisory Service. Can you see the presentation?
Yep, just full screen, and then if you go to full screen, then we'll be.
Yeah, absolutely. So we've got a range of supports, but the main one being the Brexit voucher support. So it's £2,000 or €2,200, €2,250 for professional advice. So I suppose what previous companies would have used the voucher to map their supply chain end to end, maybe went over the VAT or financial implications that Colleen and Frankie have mentioned previously. You can also use it to train your staff up for customs procedures or support maybe for getting your product certified, labelling and licenses. We've also got support on the digital content, and that's basically a one-stop shop for your trading goods and trading services, how it has changed, signposting and latest video guides on supporting or completing your customs declarations and things like that, looking up your commodity codes. And then there's a list of other government agencies there. There's plenty of support available, and just some of the links there. You can also go online and register or apply for our Brexit voucher online. The eligibility would be, you have to be based on the island, less than 250 employees, trade across the border, and have a turnover of less than 50 million. So that's a very quick synopsis, but the Brexit team can be contacted at brexit@InterTradeIreland.com, and just refer to our website for, I suppose, more updates and events like these. So thank you, Deirdre. That was.
Thank you very much, Denise.
Quick wrap up. All right.
Thanks a million. And just very quickly then, I wanted to say a really big thank you to our speakers for giving up their time today. Thank you so much for all of your hard work and efforts, and thank you to everybody who's attended. We will follow up. I apologise that we haven't got through all your questions. I know how frustrating that is when you really want an answer. So that's our job, to come back to you on those things, and we will do a little bit of a survey to see what we can do next and follow up on next as well. I just wanted to call out a few other things that are happening in the next few days. I know it potentially is an information overload for many people, but there's lots of things happening. So for example, tomorrow, if you go to the Enterprise Ireland website, NI Enterprise Europe Network and the local enterprise office in Donegal brings you a really good webinar called Beyond Brexit, Rising to the Challenge. You'll get super information on that. Invest NI in Northern Ireland have EU exit advice clinics. There are 6 of those running out through March, and that will be one-to-one appointments with specialist advisors. In Newry Chamber of Commerce tomorrow has a webinar with the Trader Support Service. Again, that's another one which will be valuable, and I know the Trader Support are very active out there as well. There's a North-South conference dealing with all things cross-border trade on the 10th of March. And then on the 19th of March, the Brexit Advisory Service, along with Monaghan and Cookstown and Enterprise Centre, will be holding a Moving Food Across the Border event. And then you've got lots of other things that are happening out there. And just, you have our commitment that we will come back to you as well and follow up on today's session. And I just want to say thank you very much as well to Ross from Libra for hosting today's event and to helping us get through this. Look, we managed to do it without, any technical hitches, and thanks again to Ray, to Ellie, to Frankie and to Colleen as well for all of their valuable information, and to Denise as well. And we will come back to you with a follow-up as soon as we can. Slides will become available, and this webinar will also be posted online. And thank you all for your patience as well. Just remember, we'll get there. It'll take some work, but we will all get there. So thank you, and on behalf of InterTrade Ireland, thanks a million. Bye.